Hey guys, welcome back to my channel, and in today's session we'll be looking at the determination of forward and futures prices. Yeah, so far we have covered the different kind of derivative instruments and the mechanics of the market, including the various nitty-gritties around the call and put options. So in this particular video, we'll be looking at how the forward or the future prices are determined in the market. And if you have not seen the previous videos, I recommend you go back and just have a look at them, so that you get a gist of whatever we have been doing so far, or maybe whatever we have covered so far. And in this particular video, which is just the continuation of the short course on derivatives which we are currently doing, we'll be looking at the specific forward and future prices, the determination part of them. So to begin with, we have seen what is a forward and a future contract. Forward contracts are not exchange traded, and they are they are contract between the parties which are not happened on the exchange. So they are, for example, a bank getting into a contract with another bank is a forward contract, right? And in the same way, what we have seen for the futures contract is they are traded on the market, and they are pretty standard, so to speak. So in this video, we'll be looking at how the market determines the rate of the futures in the forward contract. So just the basic part is going to be covered here. Now we know that for any price determination in the market, there has to be demand and supply, which is largely the case. But if we remove the demand supply forces from the equation for now, we just need to consider the basic assumptions by which a forward or a futures contract can be priced. So let us look at how the or what all factors are there in determination of the forward and futures prices. So I have a couple of factors here. So let's just start with what is a spot rate. Spot rate is a very easy term to follow. Now let me just pull up a new slide here and explain you, or maybe I can just pull up a duplicate slide and delete this one and explain you what is a spot rate. Alright, so a spot rate is nothing but is the rate spot rate is the rate of a given contract today. Alright, so this is what the spot rate is. Let me just indent it a bit so that you can follow here. And spot rates are very important in determining the futures rate or a forward rate, because what we essentially do is we kind of multiply the factors with the spot rate so that we get a small amount of increase in the spot rate, and that is the futures of the forward rate. Now before I delve into the the calculation part of it, I want you to understand a simple basic concept of time value of money. I know you guys already know this, but if you don't know this, I recommend that you go back and do some Google or look at some videos with respect to time value of money. Now time value of money is a very important concept, although it's a very easy concept, but it is a very important concept. Let me just remove these so that we can it just doesn't look clumsy. Now I want you to go back and read about time value of money if you haven't already. And so essentially how a futures contract is how a futures price or a forward price is determined is based upon what entails in time value of money. So so for the better part of the users, I believe that they are aware of this concept, and I will just quickly explain you how a futures or a forward price can be calculated with respect to time value of money. So what happens in time value of money is you kind of figure out what can be the future value, alright, future value or the present value. All right, present value of a given financial instrument, or of a given commodity, or of a given stock, bond, anything, or of a given, let's just say financial instrument. All right, now what happens is, if you want to calculate the FV, or the future value of any financial instrument, what you do is, uh, you take the present value and then you multiply it with 1 plus the rate, right, 1 plus the interest rate raised to n, and n can be the time. So n is the time factor, and rate is the interest rate which is prevalent in the market. All right, and then you kind of like multiply the present value of any financial instrument to get the future value of that instrument. Now let me just quickly raise it. Where is this? Raise to n. All right, or maybe n, or n, as you might have read in the equations. So this is the basic concept. Now for any particular you know financial instrument you take, its value is going to increase in the future because of this underlying concept, and we'll be applying the same concept here in this particular calculation part of the forward of the future prices, right? So since this is out of the way, since we are aware of this particular concept of future value, now let me just give you a small equation here for understanding how the forward or the future prices can be determined. So forward rate, which can be denoted by FO, I'm just gonna take 0 here so that it is visible properly. So F0 can be S0, which is the spot rate, times, I'm just gonna write a small e here. I'll explain what that means later on, times e raised to the power r and t. All right, now what are these things? I want you guys, I don't want you guys to get intimidated. It's just e is a symbol for continuous compounding. All right, and t is the time to, let's say, time to maturity, and r is the rate of interest. All right, so these are the things which just determines the forward price. Now I know you're kind of wondering, hey look, how do I calculate the futures price? So let me just quickly tell you that time to maturity is very easy to calculate. I'm just giving you the concept here. I don't want you guys to go back and do the calculation yourself, because it just doesn't happen that way in the real world. It's just for you, for your understanding, that I'm giving you these equations so that you get an inherent understanding of what happens and how would you basically figure out the price of any particular futures contract. Now we are certainly working under the assumption that there is no borrowing cost, and there is no trading costs, like there is no brokerage cost, which is not the case in the real world. So you would never be able to figure out value of a forward rate, but then yes, you can always give it a try, and with respect to this particular formula, you can basically come to a point where you can get an understanding of what can be the forward rate, and if it is equal to the market or not. So for example, let's just say that there is this contract which is trading at $50, and by doing this particular equation, you figured that it should not be, it should be 51, or maybe it should be 52. Then what you would do is you would go ahead and buy that contract. All right, now this happens all the time. So arbitrages, they try to determine the price on their own, and then they keep on buying and selling the contracts. So you would seldom come to a point wherein there could be an opportunity for you to make the purchase and get some money out of it. So this is a particular thing wherein we need to be very careful while doing the calculation, because first E is the continuous compounding, and I'm not sure if you are aware of this, but continuous compounding doesn't work in the real world. I mean, banks do it on a 365 days basis, and uh, for our understanding we can do it as continuous, but for what I have seen, there may be half yearly compounding or quarterly compounding contracts. R is nothing but the rate of interest which is prevalent in the economy, and you can pick up the 3 months LIBOR rate, or maybe you can pick up the 3 months G-Sex rate, which is what you would get if you were to invest the money safely. And the T is the time to maturity or expiry of the contract. Alright, with this notion out of the way, let's just understand the or examine the forward prices and the futures prices, and how they are related to the spot and or spot prices of the underlying assets. So you might have well noticed that if the spot price goes up or down, the futures price would obviously go up and down. It would definitely go up and down, and because of this T factor, which is a decay, which specifically is going to be a decay. So the value of F0 today is greater than will always be greater than value of F0 tomorrow, uh, given other things remain constant. So the value of a contract which you want to buy today till a specific maturity is always going to be greater than the value tomorrow, or maybe day after tomorrow. So this is what it entails, and let's take a look at what can be the difference is in, and this is how you would also value the futures contract. It's just that futures contract trade in the market, and their price kind of like changes on a daily basis. So for example, if this would have been a forward contract, you would have bought this, right? You would have bought this today, and it would have remained a little bit similar tomorrow, right? But for example, if you bought this as a futures contract in the market, tomorrow it might be the case that this would change, because as opposed to a forward contract, this particular thing is not going to be constant in the futures contract. So it is going to be always different the next day, or maybe sometime after you've bought the futures contract. So for example, S0 in the futures contract is not going to be the same, and as a result the value of a futures contract will change more often than a forward contract. So I'm just gonna take this indent this a little bit, and or maybe let's just pull it a little bit up so that it is visible, the whole thing is visible to you guys. Alright, so yeah, so this is what I wanted to highlight here while determining the forward and futures prices. Now let's go back to the first slide. Yeah, this is the first slide, and see what all we have covered. So we have covered what is a spot rate, what is a futures or a forward rate. Now forward rate or a futures rate is what you would get after doing this particular thing here. If you're not sure of the continuous compounding, I just want you to go back and look at any particular video there, and you would be definitely able to get this concept easily. It's a very easy thing. Alright, so this is what we have covered, and how a futures or a forward price is related to the spot price. Like I have already mentioned, if the spot price changes so often, then that's going to be changing the futures price, right? And now let us look at what are investment versus consumption assets. So now let's get back to the commodities business here. So let me just quickly pull up a duplicate slide, and I can go back and remove all of this, right? And what are investment versus consumption assets? Alright, so investment assets can be what? Stocks, bonds, right, gold, and let's say silver. However, consumption assets can be coal, oil, corn, all right, and it can be any other stuff which you leather. All right, so if you have a futures market for these commodities, then there is a, you know, the pricing equations tend to differ because of certain factors. Now, what are those factors? Let's go back to the first slide and, you know, copy those factors. So let's look at these factors and how do they, you know, change the pricing of those things. All right, so let's come back here and let's just paste them. All right, so these are the factors which we will be looking at with respect to determining the prices of futures and the forward contracts in the investment assets and the consumption assets. So let's look at what is a known income or a dividend income. So if there is a known income out of that asset, you know, what tends to happen is if you were to buy the futures contract, or if you were to price the futures contract based upon that asset, you will have to kind of like less the value of the dividend or the value of the interest received on that asset, which is again yield, which we'll talk about in some time. But yes, if there is a dividend expected in that on that particular asset, what tends to happen is the formula would change a little bit. So FO, like F0 is equal to S0, you know, minus the interest rate, minus the interest or the income, and then once you have subtracted the income of the dividend or maybe, you know, the interest, then you will have to like multiply it by the factors to get the value for your futures contract or the forward contract. Alright, so known income or dividend is something which is treated like this. Then again, the known yield. So for a known yield, what happens is, for example, let's take a let's take an asset for which there is a yield of say 5% or 10% or whatever percentage. Then what you have to do is you have to convert that yield into a continuous yield, and then subtract it with the amount of interest rate which you're gonna take in this particular calculation. So for example, here we saw that there is an interest rate here, so this less the known yield, because what yield is basically again the income which you're getting. So anything which you're getting has to be subtracted. It could be dividend or it could be income on that particular asset. So let's look at how the formula construction would work here. So FO, right, so FO equal to SO, and I'm just gonna write continuous compounding, and raised to R minus, let's say, Q, small q, which is the yield. This is the yield part. Alright, again yield has to be converted into continuous compounding for the pricing to make sense. So this less times T, right? So this is, so for example, the rate of interest in the economy prevalent was let's say 4%, so it could be 4%, 0.04 minus, if the yield was let's say 10% per annum, and if on the basis of continuous compounding it comes out to be 1% for the time period, then it could be less 0.01 because it's 1%. Alright, so in this way you will be able to figure out the value for futures of the forward contract on the basis of a known yield. Known yield is nothing but a percentage of income expected out of the security or the asset in question. Now let's look at the income and storage cost on commodities. For example, there is some income which is to be expected out of the commodity, or if there is a storage cost on the commodity, then how would you figure out the forward contract? So when we talk about storage cost, it is something which is going to go out of our pocket. So for example, if you say F0 is the futures or the forward contract or the forward price you're trying to ascertain, then what happens is F0 is going to be S0 plus let's say U, which is the storage cost, which has to be added into the initial cost of the asset or initial price of the asset, so to get a better view, or so to accommodate the storage cost on the forward prices. So that is what you would do. Rest is going to be the same. It's, you just have to multiply it by the factor of time and the interest rate. Again, convenience yield is something which gives certain value to a commodity with respect to keeping it physically vis-a-vis, you know, keeping it in a paper form. All right, so for example, if you are in the business of gold, and if you have gold in hand as against gold in paper, you can quickly use the gold in hand to create jewelry and quickly capture the market if there is a sudden increase in the demand. That is convenience yield, right? So that is the convenience of having something on hand so that you can quickly use it. So let's look at how that is going to be factored here. So for example, we have seen in the known yield case that there is a, you know, what we do is we kind of like deduct the kind of yield or the kind of the income from the interest rate, so to get a better view of the prices or the pricing. The same is going to be happening here. So F0 is equal to S0, you know, times E raised to R minus Y, Y being a convenience yield, and raised to T. Alright, so this is what typically it would look like, because convenience yield is something which gives you income quickly, you know, and as a result it is kind of like deducted from the interest rate. So this is what the convenience yield would look like. But at the same time, just think about it, guys. If you are having something on hand, then there is a storage cost to it, right? So there has to be something added to this, because you're getting an income here, and as a result of that there is a storage cost. Alright, so we've talked about income and storage cost. So if there is an income, that gets deducted, but if there is a cost like a storage cost here, you know, it would get, you know, added here. So you have to also add a small u here, you know, that is the cost. You, if you convert it into percentage terms, and then if you convert it into continuous compounding, then that is what the factor which comes here. Because while you're, you know, reaping the benefit of convenience yield, you're also paying something for the storage, right, of that particular gold, which I just talked about in my previous example. So for example, if you had a gold, what you would have to do is you would have to keep it in a bank storage, and then you have to pay the storage. That is what is added here. So that is what extra is added here, right? So these are the kind of factors which typically, you know, underlying factors which tend to change the pricing of forward and futures contract. So when I talk about these factors, these factors typically help you understand the forward pricing much more than the futures pricing, because futures pricing is there are a lot of factors in futures pricing. If you just look at the market, you know, there are a lot of people trading, you know, back and forth, and there's demand and supply of futures contract, and then there is a cost on the interest rate. Like there's a cost on borrowing money. If you want to borrow money from the bank's going to charge something, right? So that is something. Then there is brokerage charges, there is margins to be maintained. So it typically tends to get, you know, very difficult to understand the pricing of futures contract. But then yes, the forward and the futures prices move in tandem, and they would typically be very closer to each other. So even if you do a paper pencil, you know, kind of calculation or back of the envelope calculation based upon your assumptions, it is going to be closely related to what the futures prices are in most cases, if you have taken all the factors properly. Alright, so with this, let's wrap this up here and look at whatever we have seen so far. So we have seen a couple of things here. So whatever we have, what all we have seen, what is a spot rate, that's what we have seen in this particular video. Then we have seen what is a future and a forward rate, and how are these related to the spot prices, and then investment versus consumption assets, what are those, and then what are the factors which affect kind of the pricing of forward and futures contracts on the overall. So I hope you have enjoyed this particular video, and stay tuned for you know, more such videos in the future. And next up we'll be doing a valuation of a simple put or a call option and how they are kind of like traded in the real world. Alright guys, bye for now and see you in the next video. Thank you.